Ready to master real estate finance? This video covers 50 must-know questions on financing, mortgage types, and key principles to help you pass your exam. Plus, keep an eye on the bottom corner for a study-boosting surprise. Let's get started.
Let's begin with a review of mortgage basics and loan types. Types of mortgage loans. Which type of mortgage loan is specifically designed for military veterans and offers benefits such as no down payment? Is it A, conventional loan, B, U.S. Department of Veterans Affairs, VA loan, C, Federal Housing Administration, FHA loan, or D, U.S. Department of Agriculture, USDA loan? The answer is B, U.S. Department of Veterans Affairs, VA loan. VA loans are offered to military veterans and active duty service members. They are backed by the Department of Veterans Affairs and often require no down payment, making them attractive for eligible borrowers. What is the primary advantage of a USDA loan for eligible homebuyers? Is it A, higher loan limits, B, no credit check, C, no down payment, or D, lower interest rates? The answer is C, no down payment. USDA loans are intended for rural and suburban homebuyers and offer the benefit of no down payment. This makes them an attractive option for those who qualify based on location and income.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
What distinguishes an FHA loan from a conventional loan? Is it A, FHA loans are government-backed, B, conventional loans have no insurance, C, FHA loans have higher interest rates, or D, conventional loans require no down payment? The answer is A, FHA loans are government-backed. FHA loans are insured by the Federal Housing Administration and are designed to help lower-income borrowers with lower credit scores, while conventional loans are not government-backed and often have stricter credit requirements. Which type of mortgage loan is generally most suitable for a first-time homebuyer with a low credit score? Is it A, conventional loan, B, U.S. Department of Veterans Affairs, VA loan, C, U.S. Department of Agriculture, USDA loan, or D, Federal Housing Administration, FHA loan? The answer is D, Federal Housing Administration, FHA loan. FHA loans are ideal for first-time homebuyers with lower credit scores because they offer lower credit score requirements and are government-insured, reducing the risk for lenders. What is a key requirement for obtaining a USDA loan? Is it A, must be a first-time homebuyer, B, property must be in a rural area, C, must have military service, or D, must have a high credit score? The answer is B, property must be in a rural area. USDA loans require the property to be located in a designated rural area, and the borrower must meet income eligibility requirements, which are based on the area's median income. Fixed rate versus adjustable rate mortgages. What is a primary advantage of a fixed rate mortgage over an adjustable rate mortgage? Is it A, lower initial interest rates, B, stable monthly payments, C, potential for lower payments if interest rates drop, or D, less paperwork and simpler application process? The answer is B, stable monthly payments. Fixed-rate mortgages offer stable payments throughout the loan term, providing predictability and ease in budgeting. ARMs may start with lower rates, but can adjust, making future payments uncertain. Which scenario is most suitable for choosing an adjustable rate mortgage? Is it A, long-term stability in payments, B, avoiding any risk of payment increase, C. Short-term homeownership plan. Or D. Desire for a fixed interest rate. The answer is C. Short-term homeownership plan. ARMs are ideal for short-term homeownership plans because they start with lower rates, which can save money if the property is sold before rate adjustments. How does the initial interest rate of an adjustable rate mortgage typically compare to that of a fixed rate mortgage? Is it A. Lower in ARMs, B. Higher in ARMs, C. The same as fixed rate mortgages, or D. Dependent on the lender's discretion? The answer is A. Lower in ARMs. ARMs generally offer lower initial interest rates compared to fixed rate mortgages, making them attractive for borrowers who plan to move or refinance before rates adjust. What is a potential disadvantage of an adjustable rate mortgage after the initial fixed period? Is it A. Limited loan term options, B. Higher closing costs, C. Immediate rate adjustment, or D. Increased payments if rates rise? The answer is D. Increased payments if rates rise. After the initial fixed period, ARMs can adjust to higher interest rates, leading to increased monthly payments and potential financial strain for borrowers.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Balloon, interest-only, and graduated payment loans. What is a primary characteristic of a balloon mortgage? Is it A. Fixed interest rate throughout the term, B. Large final payment at the end of the term, C. Adjustable interest rates, or D. No down payment required? The answer is B. Large final payment at the end of the term. A balloon mortgage has a large final payment due at the end of the loan term. Unlike traditional loans where payments are spread evenly, this can pose a risk if the borrower cannot refinance. Which of the following is true about interest-only loans? Is it A. Borrowers pay only the interest for a set period, B. They typically have higher initial monthly payments, C. They are always fixed-rate loans, or D. Principal payments are required from the start? The answer is A. Borrowers pay only the interest for a set period. Interest-only loans allow borrowers to pay only the interest for a specific period, after which they must begin paying both principal and interest, potentially increasing monthly payments significantly. How does a graduated payment mortgage work? Is it A. Payments remain constant throughout the loan, B. Interest rates decrease over time, C. Payments decrease as the loan progresses, or D. Initial payments are lower and increase over time? The answer is D. Initial payments are lower and increase over time. A GPM starts with lower payments that gradually increase over time. This structure helps borrowers who expect their income to rise, making it easier to afford higher payments later. What is a potential risk of an interest-only loan? Is it A. Guaranteed lower total interest paid, B. Immediate equity buildup, C. Payment shock after the interest-only period, or D. Reduced risk of default? The answer is C. Payment shock after the interest-only period. Interest-only loans carry the risk of payment shock, where monthly payments significantly increase once the interest-only period ends, as borrowers must then pay both principal and interest. Let's continue with loan qualification and underwriting. Loan-to-value ratio and debt-to-income ratio. What is the primary purpose of calculating the loan-to-value ratio in mortgage underwriting? Is it A. To determine the borrower's credit score, B. To assess the lender's risk, C. To calculate monthly mortgage payments, or D. To establish the property's market value? The answer is B. To assess the lender's risk. The LTV ratio helps lenders assess the risk of a loan by comparing the loan amount to the value of the property. A lower LTV indicates less risk because the borrower has more equity. How does a high debt-to-income ratio impact a borrower's mortgage application? Is it A, it suggests higher financial risk for the lender? B, it guarantees loan approval? C, it results in a lower interest rate? Or D, it has no impact on the application? The answer is A, it suggests higher financial risk for the lender. A high DTI ratio indicates that a borrower has a significant portion of their income going to debt payments, suggesting higher financial stress and risk for the lender. Which scenario is most likely to result in a favorable loan-to-value ratio? Is it A, a borrower with a low credit score? B, a property with declining market value? C, a borrower making a large down payment? Or D, a borrower with high existing debt? The answer is C, a borrower making a large down payment. A favorable LTV ratio is typically lower, indicating more borrower equity. A large down payment reduces the loan amount relative to the property's value, improving the LTV. Why might a lender prefer a borrower with a low debt-to-income ratio? Is it A, it indicates the borrower has a high credit score? B, it guarantees the borrower will not default? C, it allows for a higher interest rate? Or D, it shows the borrower can manage additional debt? The answer is D. It shows the borrower can manage additional debt. A low DTI ratio suggests that the borrower has less of their income committed to existing debt, indicating a higher capacity to manage new loan payments comfortably. Credit scores and loan qualification. How does a higher credit score generally impact loan qualification? Is it A, it improves loan terms and increases approval chances? B, it has no impact on loan qualification? C, it results in higher interest rates? Or D, it decreases the loan amount available? The answer is A, it improves loan terms and increases approval chances. A higher credit score typically results in better loan terms, such as lower interest rates and higher borrowing limits. Lenders view high scores as an indication of lower risk. What is the minimum FICO score generally required to qualify for a conventional mortgage? Is it A, 580, B, 620, C, 700, or D, 750? The answer is B, 620. Most conventional mortgage lenders require a minimum FICO score of 620. This threshold helps lenders assess the borrower's ability to repay the loan. Which factor is least likely to affect a borrower's credit score? Is it A, credit utilization ratio, B, payment history, C, length of credit history, or D, type of employment? The answer is D, type of employment. While credit utilization, payment history, and length of credit history significantly impact credit scores, the type of employment is not directly considered. Income, assets, and employment verification. Which of the following is typically required for verifying an applicant's income during the loan underwriting process? Is it A, a letter from the applicant's employer, B, recent pay stubs and tax returns, C, a signed statement from the applicant, or D, bank statements from the last month? The answer is B, recent pay stubs and tax returns. Verification of income typically requires recent pay stubs, tax returns, and W-2 forms to ensure that the applicant's stated income is accurate and reliable. This step is crucial for assessing the borrower's ability to repay the loan. What is the primary purpose of verifying an applicant's employment during the loan qualification process? Is it A, to ensure the applicant has a stable income source, B, to determine the applicant's job satisfaction, C, to assess the applicant's career growth potential, or D, to verify the applicant's professional skills? The answer is A, to ensure the applicant has a stable income source. Verifying employment ensures that the applicant has a stable source of income, which is critical for determining their ability to repay the loan. This step helps lenders assess the risk of lending to the applicant. Which asset verification method is most commonly used to confirm an applicant's available liquid assets? Is it A, a letter from the applicant's financial advisor, B, a signed affidavit from the applicant, C, recent bank statements, or D, a copy of the applicant's investment portfolio? The answer is C, recent bank statements. Bank statements are commonly used to verify liquid assets as they provide detailed information on the applicant's account balances, ensuring the lender of the applicant's financial stability and ability to cover down payments or closing costs. Let's test your understanding of mortgage markets and lending institutions. Primary versus secondary mortgage market. What is the primary purpose of the secondary mortgage market? Is it A, to issue new mortgage loans directly to borrowers, B, to provide liquidity by purchasing existing mortgage loans, C, to set interest rates for new mortgages, or D, to manage foreclosures and loan defaults? The answer is B, to provide liquidity by purchasing existing mortgage loans. The secondary mortgage market exists to provide liquidity to the primary mortgage market by allowing lenders to sell mortgages, freeing up capital to issue new loans. It enhances stability and efficiency. Which entity is most commonly associated with the secondary mortgage market? Is it A, a local credit union, B, the Federal Reserve, C, Fannie Mae, or D, a mortgage broker? The answer is C, Fannie Mae. Fannie Mae is a government-sponsored enterprise that plays a major role in the secondary mortgage market by buying mortgages from lenders and selling them as mortgage-backed securities. How does the secondary mortgage market impact interest rates in the primary market? Is it A, it helps stabilize and potentially lower interest rates, B, it directly sets interest rates for new loans, C, it has no impact on interest rates, or D, it causes interest rates to fluctuate unpredictably? The answer is A, it helps stabilize and potentially lower interest rates. By providing liquidity, the secondary market helps stabilize interest rates. If lenders can sell loans easily, they can offer more competitive rates in the primary market.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Fannie Mae, Freddie Mac, and Ginnie Mae. What is the primary function of Fannie Mae in the mortgage market? Is it A, to purchase mortgages from lenders and provide liquidity, B, to directly lend money to homebuyers, C, to regulate interest rates for mortgage loans, or D, to provide insurance for mortgage-backed securities? The answer is A, to purchase mortgages from lenders and provide liquidity. Fannie Mae primarily buys mortgages from lenders, providing them with capital to issue more loans. This helps maintain liquidity in the mortgage market, ensuring that funds are available for homebuyers. How does Freddie Mac differ from Fannie Mae in its operations? Is it A, Freddie Mac directly issues mortgage loans to consumers, B, Freddie Mac focuses on purchasing loans from smaller banks, C, Freddie Mac regulates the interest rates for mortgages, or D, Freddie Mac only deals with jumbo loans? The answer is B, Freddie Mac focuses on purchasing loans from smaller banks. Freddie Mac and Fannie Mae both buy mortgages, but Freddie Mac primarily focuses on purchasing loans from smaller banks and lenders, facilitating competition and diversity in the mortgage market. What role does Ginnie Mae play in the mortgage-backed securities market? Is it A, Ginnie Mae directly purchases mortgages from lenders? B, Ginnie Mae regulates the mortgage interest rates? C, Ginnie Mae guarantees payments on mortgage-backed securities? Or D, Ginnie Mae issues loans directly to homebuyers? The answer is C. Ginnie Mae guarantees payments on mortgage-backed securities. Ginnie Mae guarantees timely payments on mortgage-backed securities backed by federally insured loans, ensuring stability and investor confidence in the securities market, which is crucial for affordable housing finance. Which of the following is a key difference between Ginnie Mae and the other government-sponsored enterprises? Is it A, Ginnie Mae purchases loans directly from lenders? B, Ginnie Mae issues mortgage loans to consumers? C, Ginnie Mae regulates the mortgage market? Or D, Ginnie Mae is a government corporation, not a GSE? The answer is D. Ginnie Mae is a government corporation, not a GSE. Unlike Fannie Mae and Freddie Mac, Ginnie Mae is a government corporation that guarantees securities backed by government loans, not a GSE. This distinction affects its operations and market role. Mortgage brokers versus direct lenders. What is a key difference between a mortgage broker and a direct lender? Is it A, mortgage brokers are the ones who fund the loans? B, direct lenders provide loans directly to borrowers? C, mortgage brokers offer fewer loan options than direct lenders? Or D, direct lenders usually charge higher fees than mortgage brokers? The answer is B. Direct lenders provide loans directly to borrowers. Mortgage brokers act as intermediaries, connecting borrowers with lenders, while direct lenders provide loans directly to borrowers. This distinction affects the loan process and potential costs for borrowers. Which of the following is an advantage of using a mortgage broker over a direct lender? Is it A, access to a variety of loan products from multiple lenders? B, faster loan approval process? C, lower interest rates guaranteed? Or D, no fees associated with the broker's services? The answer is A, access to a variety of loan products from multiple lenders. Mortgage brokers can offer access to a variety of loan products from different lenders, providing more options and potentially better terms for borrowers compared to a single direct lender. Why might a borrower choose a direct lender over a mortgage broker? Is it A, to access a wider range of loan products? B, to ensure independent advice on loans? C, to avoid any broker fees? Or D, for a potentially simpler and more direct loan process? The answer is D, for a potentially simpler and more direct loan process. Borrowers might prefer direct lenders for a potentially simpler process, as these lenders handle all aspects of the loan in-house, which can streamline communication and decision-making. Now let's look at loan costs, disclosures, and regulations. Truth in Lending Act and RESPA. Which of the following is a requirement under the Truth in Lending Act regarding the disclosure of finance charges? Is it A, disclosure of only the interest rate? B, disclosure of the total finance charge? C, disclosure of only the principal amount? Or D, disclosure of the loan term only? The answer is B, disclosure of the total finance charge. TILA mandates that lenders disclose the total finance charge, which includes all costs associated with the loan, to ensure borrowers understand the full cost of borrowing. Under RESPA, which document must be provided to borrowers within 3 business days of receiving a loan application? Is it A, loan estimate? B, closing disclosure? C, annual percentage rate statement? Or D, truth in lending disclosure? The answer is A, loan estimate. The loan estimate form must be provided within 3 business days of receiving a loan application, detailing loan terms and closing costs under RESPA requirements. What is the primary purpose of the Real Estate Settlement Procedures Act? Is it A, to regulate interest rates on mortgages? B, to ensure lenders provide fair loan terms? C, to provide transparency in settlement costs? Or D, to standardize mortgage application forms? The answer is C, to provide transparency in settlement costs. RESPA aims to protect consumers by ensuring they receive timely information about the costs of the settlement process, preventing abusive practices, and promoting transparency. Which of the following is a key feature of the TILA RESPA Integrated Disclosure Rule? Is it A, it eliminates the need for any disclosures? B, it applies only to commercial loans? C, it requires lenders to provide a single disclosure form? Or D, it combines TILA and RESPA disclosures? The answer is D, it combines TILA and RESPA disclosures. TRID combines the TILA and RESPA disclosures into two forms, the loan estimate and the closing disclosure, simplifying the mortgage process and enhancing consumer understanding. Loan estimate and closing disclosure forms. What is the primary purpose of the loan estimate form in mortgage transactions? Is it A, to provide borrowers with a clear summary of loan terms and costs? B, to finalize the loan agreement between lender and borrower? C, to replace the need for a closing disclosure form? Or D, to calculate the borrower's credit score? The answer is A, to provide borrowers with a clear summary of loan terms and costs. The loan estimate form provides borrowers with important information about the key features, costs, and risks of the mortgage loan they are applying for. It helps ensure transparency and informed decision-making. Which section of the closing disclosure form details the costs paid by the borrower at closing? Is it A, loan terms? B, contact information? C, closing costs? Or D, escrow account information? The answer is C, closing costs. The closing costs section of the closing disclosure form itemizes all costs the borrower must pay at closing, including loan costs and other fees. This ensures transparency and helps avoid surprises. When must a lender provide the closing disclosure form to the borrower? Is it A, at the time of loan application? B, at least 3 business days before closing? C, on the day of closing? Or D, 1 week after the loan closes? The answer is B, at least 3 business days before closing. The lender must provide the closing disclosure at least 3 business days before the loan closes. This requirement allows borrowers time to review the final terms and costs and ask questions if needed.
Notice the code in the corner? When you're stumped by a question, enter it at Birdsy.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Predatory lending practices and protections. Which of the following is a common characteristic of predatory lending practices? Is it A, offering below-market interest rates? B, providing transparent loan terms? C, charging excessive fees and interest rates? Or D, requiring a low down payment? The answer is C, charging excessive fees and interest rates. Predatory lending often involves charging excessive fees and interest rates, misleading borrowers, and making loans without regard to the borrower's ability to repay. These practices exploit vulnerable borrowers. What is a primary regulatory measure designed to protect consumers from predatory lending? Is it A, allowing prepayment penalties? B, the Truth in Lending Act? C, increasing loan origination fees? Or D, promoting adjustable rate mortgages? The answer is B, the Truth in Lending Act. The Truth in Lending Act mandates clear disclosure of loan costs and terms, helping consumers make informed decisions and protecting them from deceptive lending practices. How does the Homeownership and Equity Protection Act help prevent predatory lending? Is it A, It sets additional disclosure requirements for high-cost loans. B. It eliminates adjustable rate mortgages. C. It reduces the interest rates on all loans. Or D. It allows lenders to waive certain fees. The answer is A. It sets additional disclosure requirements for high-cost loans. HOEPA provides additional protections for high-cost loans, requiring specific disclosures and prohibiting certain terms to prevent abusive lending practices, safeguarding borrowers from exploitation. Let's continue with a review of foreclosure and loan default. Judicial versus non-judicial foreclosure. What is the primary difference between judicial and non-judicial foreclosure processes? Is it A. Judicial foreclosure is faster than non-judicial foreclosure? B. Judicial foreclosure requires court involvement, while non-judicial does not? C. Non-judicial foreclosure is more costly for lenders? Or D. Judicial foreclosure does not provide a redemption period for borrowers? The answer is B. Judicial foreclosure requires court involvement, while non-judicial does not. Judicial foreclosure involves court oversight, providing a legal pathway for the lender to take possession of the property. Non-judicial foreclosure bypasses court involvement, often resulting in a quicker resolution. In which type of foreclosure does the lender need to file a lawsuit to initiate the process? Is it A. Judicial foreclosure? B. Non-judicial foreclosure? C. Equitable foreclosure? Or D. Administrative foreclosure? The answer is A. Judicial foreclosure. In a judicial foreclosure, the lender must file a lawsuit against the borrower to begin foreclosure proceedings. This legal action is necessary to obtain a court order to sell the property. Which type of foreclosure is typically faster and less expensive for lenders? Is it A. Judicial foreclosure? B. Strict foreclosure? C. Non-judicial foreclosure? Or D. Voluntary foreclosure? The answer is C. Non-judicial foreclosure. Non-judicial foreclosure is often faster and less costly because it avoids lengthy court procedures, making it a more efficient option for lenders seeking to recover their investment. Which statement is true regarding the borrower's right of redemption in foreclosure? Is it A. Non-judicial foreclosure always includes a redemption period? B. Judicial foreclosure never allows redemption? C. Redemption is only available before the foreclosure sale? Or D. Judicial foreclosure may include a redemption period after the sale? The answer is D. Judicial foreclosure may include a redemption period after the sale. The right of redemption allows borrowers to reclaim their property by paying the full debt. This right is more commonly associated with judicial foreclosure, where the court may grant a redemption period. Short sales and loan modifications. What is the primary goal of a loan modification in the context of foreclosure prevention? Is it A. To increase the lender's profit? B. To make the loan more affordable for the borrower? C. To expedite the foreclosure process? Or D. To eliminate the borrower's debt? The answer is B. To make the loan more affordable for the borrower. A loan modification aims to make the loan more affordable for the borrower, reducing the risk of foreclosure. This can involve adjusting interest rates, extending the loan term, or reducing the principal balance. Which of the following is a key difference between a short sale and foreclosure? Is it A. Short sales always result in a profit for the lender? B. Foreclosure benefits the homeowner financially? C. Short sales are voluntary, while foreclosures are legal proceedings initiated by lenders? Or D. Foreclosures require homeowner approval? The answer is C. Short sales are voluntary, while foreclosures are legal proceedings initiated by lenders. In a short sale, the homeowner sells the property for less than the mortgage balance with lender approval, avoiding foreclosure's credit impact. Foreclosure is a legal process where the lender seizes the property due to default. What is a common outcome for borrowers who successfully complete a loan modification? Is it A, lower monthly mortgage payments, B, immediate elimination of mortgage debt, C, increase in interest rates, or D, foreclosure proceedings? The answer is A, lower monthly mortgage payments. Successful loan modifications typically result in lower monthly payments, enabling borrowers to manage their finances better and avoid foreclosure. This adjustment helps stabilize their financial situation.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.